for the final exam. Okay, next will be on goodwill. What is goodwill? According to para 32 of IFRS number 3, goodwill is measured at the acquisition date and occurs when consideration transferred plus the non-controlling interest in the acquisition plus the acquirer previous held equity interest in the acquiry is greater than the net fair value of identifiable asset acquired and liability assumed. So what does it mean? It means that you need to determine what is the consideration transfer, how much you give up to acquire company B, including on the date of acquisition plus the previous date. If you have acquired it slowly or have a several process or step, okay, you include all that cost plus the non-controlling interest. What is the value of the 20% NCI? And then you minus the fair value of identifiable net asset. Let me just give you simple examples. The fair value of identifiable net assets is 100 million. This is 100 million. Okay. You acquire today on the date of acquisitions, yeah, your purchase consideration or consideration transferred is 70 million. Okay. Before this, you also have made some acquisitions, yeah, another 20 million. 20 million. So this is you. A. You own 80% of the shares. So this is already 110 million. This is 110 million. Okay, this is UA. And you have remaining 20%. This is non-controlling interest. Non-controlling interest. A group of shareholders, not you, other parties. Okay, this 20%, maybe the value is 22 million. This is 90 million. 90, I just put here 22 million. So this is 110. No, this is 70, 90 million. 90 million, yeah. So the value for this one is 22 million. So total here is 102 million. Yeah, 102 million. The fair value of identifiable net asset is 100 million. So you compare this figure with this, and you found that the purchase considerations or consideration transfer is greater than the fair value of identifiable net asset. So in that case, your goodwill is equal to 2 million. 2 million. Yeah, the goodwill is 2 million. So goodwill arises when consideration transferred is greater than the net fair value of identifiable asset acquired and liability assumed. So when your considerations transferred is greater than the fair value of identifiable net assets. Net asset means, what is net asset? Asset minus liability, yeah, rather than fair value of identifiable asset acquired and liability assumed. Normally I use the term fair value of identifiable net asset. Net asset means asset minus liability. Asset acquired and liability assumed. So you have goodwill here. Okay. So to measure goodwill, yeah, an acquisition analysis is undertaken at the acquisition date, and the consideration transferred is compared with the net fair value of identifiable asset acquired and liability assumed. So in this situation, you need to do an acquisition analysis. It helps you to determine the fair value of identifiable net asset and also the consideration transfer. Okay. So goodwill is recognized and as asset. So goodwill is assets. So asset will go to your statement of financial position and other statement of financial position or balance sheet. It will go to your balance sheet as assets, as asset. So if you look at goodwill, we have several type of goodwills there. The first one is we have going concern goodwill, and then we have combination goodwill, and this will create what we call as the core goodwill. This is just a concept, yeah. Okay, when A combined with B, they create synergy. They create synergy. They create new effects, yeah, synergy effect. Before this, they cannot perform or do the job. By combining these two, by having this different expertise, they can create a new technology. For example, I'll give you a simple example. Yeah. One company is the IT company. IT company. Good in technology, the parent. B, maybe just a marketing company. So by combining, by this acquisition process, you have different set of skill. You have different technology, different human capital. So you will create a new goodwill, combination goodwill. You can produce maybe new products, new services. Yeah. So that is what we call as combination. So this is just a concept. The next one will be the gain on bargain purchase. Gain on bargain purchase. What is this? Where an entity pays a consideration less than the net fair value of identifiable asset acquired, the acquirer is seen to have made a bargain purchase. Yeah. When consideration transferred is lower than the fair value of identifiable net asset, this will result in gain on bargain purchase. Okay, the acquirer recognize this gain on bargain purchase in the profit and loss of the acquisition. So this will not go to the reserve; it go to the income statement as a gain, Go to income or profit and loss, statement of profit and loss, and other comprehensive income. Okay. So before a gain on bargain purchase can be recognized, parenthesis of IFRS number 3 requires the acquirer to reassess whether it has correctly identified asset acquired and liability assumed, measure at fair value all the asset acquired and liability assumed, and measure the consideration transfer. Why there is a requirement here to reassess, to do another assessment? The reason is gain on bargain purchase will increase your total comprehensive income, will increase your net profit. Yeah, we don't want this acquisition is being used as a tool to inflate profit, to make profit, yeah, to recognize profit. So you have to reassess whether you have done it correctly. Okay, let us look at this example. This is just a simple example from textbook, example 25.3. Okay. The information from illustrative example 25.1 is a continuity, but I'm going to use a simple one here. Is used in this example, yeah, except the identified asset acquired have the following fair value. So in this question, in this example, you already given the fair value of identifiable net assets. This is the fair value. Okay. So the equipment, this is the acquisition analysis. The equipment value, fair value is 90,000. Inventory is 50,000. Account receivable 28,000, and we have brand here 12,000. This is the brand 12,000. So your assets fair value is 180,000 liability assumed is 16,000. So your fair value of identifiable net asset is 164,000 in this question. So number one, you need to prepare an acquisition analysis. Number two, prepare the first journal entry to record acquisition analysis. How to record this acquisition analysis? Assuming the assessment process did not result in any changes in the fair value calculated. So in the example 25.1, they already give you the consideration transfer. We're not going to do it again, but I'm going to show the process. So what is the consideration transferred in this example? The fair value of identifiable net asset is 164,000. Fair value of identifiable net asset, the value is 164,000. Okay. Second, you're going to determine the consideration transfer. So in this example, it shows that consideration transfer is 152,000. This is a consideration transfer. The fair value of asset is 164,000. The consideration transfer is 152,000. So mean you purchase below the fair value. You purchase below the fair value. So in that case, we have gain on bargain purchase. Gain on bargain purchase. This will go to your profit and loss. Current year profit and loss. Okay. What if consideration transfer is 180,000? Other example. Your consideration transferred is 180,000. So if this thing happen, if your fair value is the same, so this will result in goodwill. Goodwill of 180 minus 64, that is 16,000. So this goodwill will go as your asset, assets. So this is the difference. You need to compare between consideration transferred and fair value of identifiable net assets. In terms of journal entry, how are you going to record the assets? How many assets that you have? 1, 2, 3, 4. You have 4 assets. This is the fair value, and this is your liability. This is your liability. Am I right? So 1 liability, 4 assets. So how are we going to record this? Debit, 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 and credit. Okay. Debit equipment 90,000, debit inventory 50,000, debit account receivable 28,000, debit brand 12,000. Okay. And credit 16,000. This is your liability. Okay. This is your liability. Another thing that you're going to record here will be the purchase considerations or consideration transferred. You're going to credit 152,000. You're going to record this. This will be credit. And again, on bargain purchase, this is also will be credit. This will be credit. This will be credit. You already record this. 4 plus 1. 4 asset plus 1 liability. Done. So you're going to record consideration transfer. It can be cash, it can be shares, it can be liability assumed. So it can be many items, yeah. And then gain on bargain purchase, credit 11276. Goodwill is asset. This is debit. Okay. So let us record the asset first. 1, 2, 3, 4. This is your asset at fair value. And then you're going to record your liability. And then going to record your gain. This is your gain. And the balance here is your consideration transfer. For example, deferred payment. yeah, consideration payable, share capital, yeah, preference share. These are all the payment, the resource that you're going to give up to complete the business combination process. So this is the asset, and this is the asset, this is the liability, this is the gain, and this is your consideration transfer. If you have only one item, cash, you don't have this, it can be only one item, cash. Yeah. Okay, let us look at the disclosures part. Yeah. The appendix requires that, okay, you provide the guidance to us. This appendix provide guidance to assist preparers in applying standard in the preparation of financial statement. Okay. So para B64 specify number of items required to be disclosed. That is number one, you must include the name and the description of the acquiree, the name of the acquiree, company that you acquire, business that you acquire, the acquisition date, what is the reason for the business combination, normally expansion of business, we want to diversify your business activity, and also qualitative description of the factors that make up goodwills. Yeah, what is the goodwill? Yeah, best thing to explain the goodwill. And then you must disclose the acquisition date, fair value of total consideration transferred, as well as the acquisition date, fair values of each major class of considerations. In previous example, we have four major classes of considerations, and also information if there is any contingent, any extra requirement agreements, yeah, subject to certain situations, contingent considerations. The amount recognized as acquisition date for each class of asset and liability assumed, yeah, must be disclosed, and any gain on bargain purchase and reason why the transaction resulted in gain. Always remember, gain on bargain purchase will go to the profit and loss. It will boost, it will increase the profit. So that's why the standard require you to put any good reason why the transaction result in a gain. It's not common to result in gains. Okay, and as summary, what we did today is we have identified, determine what are the objective of IFRS 3, determine whether transaction is a business combination or not, what are the key step acquisition method. We have 4 steps, the nature and acquirer and key factors in identification of acquirer, the acquisition date, when to recognize and how to measure identifiable asset and liability assumed by acquirer, and also what is goodwill, what is meant by bargain purchase, and what are disclosure requirements under AASB number 3 as well as IFRS number